Hey guys, Mike here. So FOMC day was today, and I've taken the Jerome Powell, what seemed like forever press conference. It seemed longer than usual, and God help you if you, like me, and you watched it, but it's like watching paint dry on a wall. But what I did was I edited it down to like 2 minutes, 45 seconds. I know like 45 minutes, like the most important things and what the market was actually looking to hear, okay? And you'll notice the market, yes, it's sold off at the end of the day, but it always does that. And so we got to look at tomorrow to see really where we're going. That's kind of what you got to wait for. But we're going to go into that. More news that came out today, economic news that sure won't justify any kind of rate cuts. I'll show you that. Then something very important, something that is lacking, and you're hearing a lot of rumbling about it in this rally. And I'm going to show you what I'm talking about. And the answer is very easy as to why it is not happening, okay? And then we'll go into some charts because obviously we have some stocks sell off major. What we're looking for in the SPY and the Qs, important levels to watch going forward from here on in. But I'm going to start off with Jerome Powell. And like I said, these are very short clips. I've edited it down to you, but these are the most important things that you really need to understand and take away going forward and what the market is really or was really listening for.
In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. But we are prepared to do more if greater monetary policy restraint is warranted.
I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June.
A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
And then this last clip is really short. He was asked more about rate cuts again, all this other stuff, and so here's what he has to say. And this kind of didn't want to tip his hand, but you can tell, he kind of had to tip his hand.
If you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
And so, what do we know here, guys? We know we're obviously close to the end. I'll be shocked if they do any more rate hikes. I think we have to get some crazy economic data for them to do any more rate hikes. I think the market knows that. Watch the 2-year yield. That's going to tell us a lot right there, because if they do go through a pause, it drops off a freaking cliff. And so keep that in mind. Now, data that did, and of course, let me know in the comments what you think about what he had to say. And if you think there's going to be more rate hikes or cuts for that matter, right? Now, the data that came out today is just stunning sometimes. I don't know why. But it's the ADP employment report. And boy, we added a lot more jobs than was expected, almost double what the estimate was. And again, guys, it's the services sector that continues to be a thorn in the side of the Federal Reserve, right? I mean, added 229,000 jobs. That's more than the whole estimate was supposed to be. And so again, we've seen these numbers be all over the place, you know, but the services sector, it's just tough. It's tough for them to break, and I think it's because they've never had to do it before. And the real question is, can they? Right? They're definitely breaking manufacturing. They're breaking banking, but the services sector is just tough, right? And now, understand, this is what I was talking about here. What is not happening right now when it comes to this rally? And it is small caps, right? And I'm going to tell you why, but check this out. So this goes back to every bottoming process we went through. And you can see the dot-com bubble. What do? This right here is small caps, up 32%. You see the NASDAQ 100 up around 57%. But again, they bottomed pretty much the same time and they participated, right? You go into 08, you see the exact same thing. NASDAQ 100 is up, small caps are up, right? Then you go into 2011, wasn't a crash or anything, but I think we did go about 20%, but you can see small caps participating. 2015, another major sell-off, and what happened? Small caps participated right along with the S&P as well. I just didn't put it in here to make the chart look a little more simple. And then you go 2018, exact same thing, right? Small caps participating. 2020, small caps participate again along with the NASDAQ and the S&P. What are you seeing now, though? Both of them look like they bottomed in October, right? The small caps started to try to participate, but what do you see? NASDAQ 100's up 26%, and then you got the small caps have basically since October gone all the way down, almost flat. They're about 3% total. So small caps are not participating in this rally. And before we continue on, if you can just hit that like and subscribe button, I sure would appreciate it. It helps out the channel a lot. And if you like this kind of content, don't forget to hit that subscribe button. It's very important for you to get notifications when these videos come out. Appreciate it, guys. And of course, it's important because, one, look at all the other rallies. They were participating. Now they're not. But here's the difference. What was the difference in all of the other rallies? Do you know? Can you put it down there in the comments? Why are small caps not participating right now? It's simple. Pull up the Fed funds rate and lay it over all of those rallies. Where was it? They had dropped them. They were almost to zero. They were doing nothing. Okay, now what do you see? Fed funds rate just got raised over 5%, highest has been since 2007 before they started dropping them. Okay, who's that going to affect? Who is all these higher interest going to affect more than anybody else? Who doesn't have a boatload and billions in cash sitting around? It's small caps, right? Who makes up the majority of the country? It's small companies, right? They don't have to be publicly traded. Smaller companies with 500 employees or less, and so that's why they're not participating. And then people are expecting these rate cuts. And I keep asking, how is the market going to react? And the real answer is you don't know, and I don't know. Nobody knows, because we've never been in a situation where how is the market going to react when it's supposed to have bottomed in October, but all of a sudden all these rate cuts, at least 3 rate cuts, are priced in this year, right? And so if inflation don't come down like it's supposed to, and they don't cut the rates, where's the market going? How's the market going to react? What's going to happen to small caps? What's going to happen to all these smaller companies who really depend on taking out debt in order to meet payroll and all the other obligations? That's the real big question, okay? And a lot of these smaller companies, what do? A lot of them supply, right, the parts, the services, and everything else to the larger companies. Or what's the larger companies doing? They're cutting back on expenses. They're cutting employees, all kinds of stuff, right? So who's that going to affect also? The smaller companies. Where do the smaller companies go to get their loans? Regional banks, right? Depending on what source you go to, 70 to 88% of commercial lending is from, regional banks. So, of course, that's where a lot of them go to. That's where they got their relationships. Who's under a lot of stress? Regional banks. What are regional banks doing with the money? They're parking it in the repo program, getting over 5%. Why in the world would you risk a loan right now, putting your money there in a loan, right? And I mean, the risk is a lot higher than it was. Okay, that makes no sense. So, just food for thought on that. And let me know what you think about that in the comments. Now, going into the SPY, and I'll keep this simple, what I'm looking for me personally is a retest of this trend line from the March 13th low right there. I need a third, touch right here. That's what I'm looking for. See if we retest that, gives me my third touch before we get a bounce or drop through. And there's plenty of support sitting at 407, way down at 392 if it decides to fall through. But again, I'm looking at 407 first, looking at the trend line. 410, a lot of support. We'll see if the bulls fight like crazy to get above that. And then, of course, trying to get through 416-ish has proven obviously to be tough. 416, 417 area. So watch that for tomorrow when we see how the market actually reacts to today, right? And what the new narrative is supposed to be now. And so then you look at this one. Obviously, you got this rising wedge here still. I want to see if we come back down, touch this trend line. You got 3 gaps. 1, 2, 3 gaps right below it. Plenty of support, 307. What else we got there? Yep, 307, 312-ish, and around 320 is going to be more of the resistance area. But if we break through that, then, of course, you'll have that gap to fill above. But it left a lot of gaps down below, guys. Now, Tesla. That's a rough looking inverse head and shoulders, but more important what I'm looking at is look at that 164 area. Looks like on the hourly, or 30-minute, MACD wants to roll over for the short term to more downside. But then again, and of course you look at this right here, just telling us we're going to get a little short term drop or whatever. But you can see that 164-ish area, man. I mean, going back to April 23rd, it's been a lot of resistance right there. But you can tell what it's trying to do is an RS flip, right? Resistance into support. That's what it's trying to do. We go to the daily. RSI is starting to move back up. Looks like the MACD wants to do a bullish cross to fill that gap above. So, keep in mind, again, I think Tesla's going to go how the market goes and what to see how they want to do it tomorrow. NVIDIA, if you're shorting this, don't feel bad. I'm going to show you something. But you can see right now, again, another resistance support flip right here. That's what this is. Finally broke out, back testing around that 281, 282 area right there. And you can see, again, we still got the divergence right there. Waiting to see if there's going to be a sell-off or not. It doesn't seem to be the case. But if you're shorting, don't feel bad, because right now this came out today that NVIDIA short sellers have lost $5 billion as the shares have rose more than 90% in just this year alone. Now, you would have thought with AMD being down as much as it was down almost 10%. And AMD, you can see, was in this channel, beautiful channel, it was moving up, right? Tested the bottom, tested the top, and it loved the year-to-date anchor VWAP. I mean, it bounced off this year-to-date anchor VWAP once, twice, 3, 4, 5 times, 6 times, actually 7 times, right? And then it's coming back up now, though, after we gap down here on earnings. Try to retest it and see if it's going to get rejected. Here's what we got to wait and see. Again, now we're going to have resistance around that 87 to 88 area. Looking for support. If it does continue to sell off around 77, so we'll see if it gets a nice bounce. I was surprised NVIDIA, or really any of them, wouldn't have done more than they were. But once again, these are semiconductors. They do what the hell they want to do. Now, as I put in the Discord today for the members, it came out all of a sudden because we saw Facebook dropping that FTC proposes barring Meta from monetizing kids' data, right? And you can see that was the reaction right there. Very quick drop. But then, shout out to Cornelius, one of our members. He put this in there with a quickness. And he said, you know what? I guess these are kids, 13 to 17. I want to make up like 3.9%. Now, again, I forgot the number of users, but I guess if you multiply that, it turns out to be quite a few. I just don't know how much money they're making off children's data, of course. But don't fret, because they actually almost fully recovered before the sell-off at the end of the day. So we'll see if that puts a dent in them or not. If anybody wants to go crunch the numbers for us and put in the comments, sure would appreciate it, and I'll let everybody know how much that could cost them if that's the case. We'll have to see. And get into earnings for tomorrow. It's going to be a lot of high beta names right in the morning. Datadog is going to be a big one. You're going to have Moderna. I wouldn't consider Royal Caribbean Cruise Line to be high beta at all, but Peloton is, that's for sure. And then you have a couple of oil companies going to report. But then the big daddy of them all, Apple, that's going to be the big one. Shopify, Block, these are high beta. Coinbase, DraftKings, Lyft, Fortinet, Carvana, there's your high beta names right there. And then the bottom, Booking Holdings. We'll see if we're traveling like crazy. I'm willing to bet we still are. Put in the comments what you think. And then, of course, economic data. You can see it's going to be pretty light, actually. You'll have the jobless numbers come out at 8:30. And, will they be hot again? We'll have to see. We are expecting an increase in initial jobless claims. But ADP, I don't know, kind of may put a damper on that one. But we'll have to wait till Friday for the big one, because that'll actually be the unemployment rate. So did it go down or go up? We expected an increase last time. We got a drop. And so again, these job reports are all over the place, right? You'll get one that's like, oh my God, that's not good, because obviously more people got hired. Congratulations to you if you did. And another one you look at it and go, oh, job market's tightening, right? But when your job market is way up here and the norm is here, you know, that's a big drop that has to happen, and it ain't going to be a straight line unless there was a major recession, right? Which is why the Fed is pricing in a recession, saying, yes, we think there'll be a recession, because recessions bring up the unemployment rate very quickly and bring down the number of jobs open and everything, bring them down very quickly. That's about the only way you can do it, because you've seen this slow grind, right? And it's like I tell the members, it's not even, you know, crazy economics. You got to understand, as long as we have jobs, we can pay bills, we can spend, we can go out on vacations. Remember, over half the country is not even responsible for their money anyway. But as long as you have a job, you can continue to live paycheck to paycheck, pay the minimum on the credit cards, and all that good stuff. It is not a problem until it is. Okay, same way with the banking stuff. Well, no problem them holding all those bonds, right? We didn't even know they were holding all those bonds, right? Until it was. Then it became a problem, and it became a problem really fast. That's normally how it happens. Okay, so we'll have to see. Again, I'm under the illusion, or I don't say illusion, I'm under the belief that, you know, I haven't seen our economy and our markets built to hold up under a Fed funds rate that's even over 4.5 for a long period of time, let alone over 5. Maybe they'll prove me wrong, but again, a crack addict does not do well without their fix. Okay, and so the fix is what? Liquidity, free money, and cheap money and all that stuff. And right now we're not having that, right? So the big mega caps are having fun with it because they got all the cash on hand. I mean, Apple is expected to report earnings tomorrow, and I think they're going to announce, or expected to announce, like $90 billion in stock buybacks, and I believe they've done over $600 billion since like 2012 or something. Think about that. 600. You know how many companies you could add together that hadn't even made $600 billion combined? It's probably, I mean, I'm talking about publicly traded companies, right? Since 2012, they haven't made that much, and they're buying back stock like that. So if you ever go, I don't understand how these stocks keep going up, but their earnings are coming down or flat. They're buying a lot of stock back. That's why, okay? And understand there's some ETFs that are going to be sweating those earnings tomorrow, because I think Apple makes up like 20 to 25% of some of these ETFs by themselves. So it's like people running those ETFs are like, oh boy, you know, they need Apple to stay strong. That's just the way it is. Okay, so let me know in the comments what you think. It's going to be good or bad. Normally they don't guide anyway, and that's usually the guidance that's been bringing any stocks down that have dropped, is the guidance, not whether they beat or not, right? And so that's going to be interesting to see. But again, the narrative we got to watch out for tomorrow is what new narrative is going to be painted. All right, are we still going to be expecting rate cuts, or now is there a new narrative to continue to push the market up and saying, well, we don't need rate cuts, the economy's strong, keep pushing forward, job numbers look great, right? I mean, is that the new narrative? So we just got to pay attention and check out and look out for that. And what I mean by narrative is big money, right? What do they want to do? And so, anyway, I'll keep you updated on it all anyway, so don't worry about that. So I hope you got something out of it, guys. Hit the like and subscribe button if you did, as always. I'll look in the comments, look for you down there. So I'll see you tomorrow.